Welcome to Investing Insights. I'm Vivien Diniz. Speaking with me today is Chris Berry, founder of House Mountain Partners. Chris, thank you for joining me today.
Thanks for having me.
Chris, when we spoke last year at the Vancouver Resource Investment Conference, we talked a little bit about deflation. Now, that was one of the main issues that were dominating the resource markets at the time. Now that we're in 2014, what are we looking at in terms of the battle between inflation and deflation, and what are the implications for junior mining investors?
Sure. Well, it still is a battle, as we spoke about last time we chatted here. I think that if anything, the evidence for deflation has become stronger since we last spoke, and that, generally speaking, is going to make it a very challenging environment in 2014 for the junior mining space. When you look at traditional sort of harbingers of inflation, you look at the direction, generally speaking, of commodity prices, those are down. You look at the money multiplier, that has collapsed. You look at the velocity of money, that has also collapsed. You look at the Baltic Dry Index, which is a major shipping index, an indicator of commerce and hence inflation, that has also collapsed. And so, I don't mean to be overwhelmingly negative here, even though it sounds like I am. I'm just saying that the evidence for deflation is much more convincing to me right now than the opposite.
But that doesn't mean that there isn't a little bit of hint of optimism somewhere out there.
That's true. And, I spend a lot of time focusing on the energy metal space, and so I'll look at those indicators like industrial demand, purchasing managers index data, and they are actually looking pretty healthy and pretty positive, which indicates manufacturing expansion actually all over the globe. We look like we may have turned the corner in the United States to some sort of sustained economic growth. It still remains to be seen. Mm-hmm. The Eurozone looks like it's coming back now, and of course, the emerging markets slowed down some dramatically, but there is still growth out there. So I think one of the positive signs heading into 2014 is that you're looking at the potential for synchronized global economic growth, and it just remains to be seen if it's sustainable.
Okay, well that sounds like it could be a positive thing for the markets. Yeah. So just to look at uranium for a little bit,
sure,
which is one of the metals that I've used to cover. In your October morning notes, you wrote that there was a nuclear renaissance that will be delayed. But we're seeing a little bit of positive sentiment in that sector of late, and I just wanted to know what you think is going to happen in the short term for the space.
Sure. I think that, again, we're still believers in uranium. I think that it's a contrarian's dream. When you look at what's happened to this space, predominantly in the wake of the Fukushima disaster, again, the need for reliable and affordable access to electricity is still there, no matter what. And uranium is currently still the cleanest and greenest way to make that happen. That doesn't mean that there aren't challenges in terms of funding and permitting and so on and so forth. But, we see higher uranium prices in 2014 and beyond. I think that it will take time for those prices to really filter through the value chain down into the junior mining space overall. But generally speaking, we're very positive on it going forward.
Okay, and as far as investors are concerned, how would investors navigate this market to make the most of it?
Sure. Well, I recommend looking at the entire value chain. I'm very interested personally right now in a company called Babcock and Wilcox. I don't have a position in it, but I'm looking at it, and they produce a number of different things, but small modular nuclear reactors. So that kind of gets you around the 10, 12, whatever $billion cost of building a large reactor, and it's a much more sort of straightforward way of potentially producing electricity through nuclear reactors. So, that's one idea. Other than that, again, you've got the juniors and the near-term production stories and the Camecos and the Arevas of the world. Within that value chain, I'm personally the most interested in near-term production. Mm-hmm. I think that that is where you're going to get the biggest sort of leverage and biggest bang for the buck right now. I think that there's a lot of excitement with respect to what's going on in the Athabasca Basin, and rightfully so, because what they're finding up there is spectacular. But from a production perspective, I think it's really only spectacular at higher uranium prices, which we don't have right now. So I am most focused on near-term production and, in particular, in-situ recovery type stories.
So that would be more on a low-cost scale.
Absolutely, absolutely. Most of the, depending upon where you are globally, the in-situ production stories can produce for, let's just say, roughly $35 a pound all in, and those are my estimates. But, even when you've got a long-term contract price for uranium of $50, when you can produce it at 35, you're in good shape.
Yeah.
But for the hard rock or for the open pit, traditional mining enterprises for uranium, you need a much higher uranium price to make it economic.
Which is something we don't have just yet.
Correct.
So one of the other energy metals that I was just hoping to touch on was lithium. Now, it was particularly quiet for lithium in 2013. Can you give us a little update on what happened in the sector? What's going on?
Sure. It was a very interesting year for lithium through M&A with everything that happened with Talison and the Chinese, and of course Rockwood. What's interesting is of the energy metals and minerals that I'm tracking, I'll look at baskets of companies again from the junior space to the large cap space, and lithium was the best performing at only down 22%.
That's actually
impressive.
That's
impressive when you consider most of them were down 35 plus. But back to your original question, the lithium space continues to consolidate. It is, I had mentioned before that it was an oligopoly in structure, and it still is. And I think that's going to make it very challenging for junior stories to try to break into it going forward. But it was an interesting year. I think that if you're interested in the lithium space, I would be looking at current producers or current end users of lithium, like, for example, Rockwood right now, that had a great year last year.
And then end users would be more like the battery companies.
Sure, absolutely. Yeah, the battery demand is strong and growing, and that is worthy of investors' consideration as well.
And most recently also, in your morning notes, I noticed you had a mention of phosphate. This is a market we've been hearing a little bit more about lately. So can you give us a little insight on what the market presents for investors?
Yeah, phosphate is obviously it's a fertilizer, so it's a food security story. That's how I view it. You have a situation, and again, I'm sure a lot of your investors will know these statistics, but global population on a net basis is growing. About 80 million people per year join humanity, if you will, and to compound that, arable land, the available sort of arable land to grow crops is shrinking.
Yeah.
In addition to that, obviously, more protein-intensive diets are being required by the global middle class. So that implies additional fertilizer demand going forward. So it's a longer-term story, but we're particularly interested in phosphates and potash as well.
Potash, but there aren't very many companies out there working into the potash space.
No, there aren't, and that's why potash or phosphate, for that matter, it's dominated by the big guys. It's another sort of oligopoly or cartel. So if you're going to invest in any near-term production stories, or even in any juniors, you need to understand what their competitive advantages are, whether or not it's grade or low cost or geopolitical jurisdiction, and go from there. And that is actually one of the reasons why we're particularly interested in phosphates, is because about 70% of global production comes from geopolitically, let's just call it unstable or uncertain parts of the world in China, Russia, and Western Africa.
Yeah.
So, the need to feed the world is going to come sort of head to head with the imperative for reliable supply.
And I think we all need to eat, so
we
it's
do.
Probably a good case for it. Well, perfect. Thank you for joining me today.
Thank you.
That was Chris Berry, founder of House Mountain Partners. I'm Vivien Diniz with Investing Insights. Thank you for joining me.